We've got Paul Mildenstein, David Goldin, and Christoph Rieck from three balance sheet lenders who all lend to small businesses. I think that's probably correct. And just to find out a bit more about them, I'm going to just ask them a few questions and tease out their business models, hopefully. So maybe if we can just all start, where does your money come from? Where's your capital liquidity come from?
Sure. So my name is David Golden. I'm the CEO of Capify. We are an alternative SME lender here in the United Kingdom, the US, Australia, and Canada. We've been operating for 14 years in the US and 8 years in the UK. Our capital primarily comes from both publicly traded and private funds.
Yeah, Paul Mildenstein from Liberis. We've been around just a little bit longer than David in the UK. We're a business cash advance company, so we lend off our balance sheet. We're unsecured, it's short term, and we've probably put out about 105 million during our lifetime. Our funds come from private, but I can announce today that we are now funded by the British Business Bank in conjunction with Shawbrook, so that kind of opens up a new opportunity for us.
Congratulations.
Thank you.
Christoph?
Hi, my name is Chris. I'm the CEO and founder of Iwoca. We're providing working capital financing to small businesses here in the UK, our home market, as well as Germany, Spain, and Poland. Very early on, we have tried to get the most cost-effective funding sources for the business, and we started issuing covered bonds to investors that typically invest in marketplaces, as many of you here in the room do. And we have further expanded that through bank facilities. So now the majority of our funding is coming from banks, which I still think is the cheapest source of funding in the economic system. And we're very proud of that achievement. And then we, as a balance sheet lender, always have to have some equity as well that we can put beneath our secured funding facilities. And we raised equity from some of the leading venture capital funds across Europe, including Commerzbank. Thank you.
And maybe sort of keeping with the business model, having seen where your funds come from, where do your customers come from? How do you source your customers? Is it conventional methods or is it new digital methods only?
We started with a very traditional broking model many years ago. That was for us one of the most effective methods for obtaining good customers appropriate to our criteria, but more importantly at a low cost of acquisition. We've now moved into a full range of multi-channel application processes. So whether it be through online search, whether it's through strategic partnerships, and we back WorldPay, we're behind their business finance proposition, or whether it's working directly with the people that are actually in the transaction itself, so the merchant acquirers, we work with those people. Undoubtedly, you have to have a number of different methods to acquire customers. I'm not sure we would sit down and say there's just one preferred one. For us, one of the most critical things is to make sure that our cost of acquisition is as low as it possibly can be, but also that our conversion of leads is as high as it possibly can do, because the whole cost model of running our business is something that's very, very critical, as I'm sure it is with most people.
Similar to what Paul just described, we have a multifaceted silos for acquiring customers as well in each of the markets. But the majority of our business, unlike many of the platforms, comes from direct, meaning that we're advertising both online through digital. We have an online application which can provide decisions within 60 seconds to a business owner. We also do, depending on the country, television, radio, direct mail. Our other silos are we do work with brokers, although it's not the majority of our business. And the third silo is strategic partnerships. We work with Alibaba in Australia, providing access to capital for the Australian SMEs. We've worked with PayPal in the United Kingdom. We work with Vantiv in the United States, which is the second largest merchant acquirer with 400,000 customers.
Christoph?
So we started out 4 years ago, and if you engage in small business lending, it takes quite a while until you build your technology platform and the processes around it to offer a product to a customer base that you can scale and where you can manage risk in the way that you're making sure that it's a profitable business. So we have done this, and while sort of we were building up our track record, we primarily acquired our customers through direct channels across sort of the mix that my two co-panelists have mentioned. And our vision of the business is that small business financing is really integrated into the day-to-day operations of our customers so that they don't have to go to a bank, that if they do a transaction, if they want to pay an invoice, if they want to import something from China through Alibaba.com, they can do this directly through these platforms with a few clicks on the checkout processes. And that's what we have done with Alibaba last year. We are now integrated into their checkout process and are catering to Spanish as well as UK businesses. And we have been expanding this quite swiftly over the last year, and certainly have a few surprises sort of for 2016 to announce that go in a similar direction.
I want to spend a little bit more time on the funding model that you have chosen. I think notice that you're all in relatively short-term SME lending, where the individual lending ticket is relatively small. Do you think that that lending model suits itself to marketplace lending, or do you think that is better served longer term by sort of skin in the game, classic finance company lending models?
I mean, I would actually say the opposite of what you just said, is that, you know, no matter what algorithms you're using, no matter what underwriting, it's a very simple formula. The longer you put the money out, the less chance it's coming back in. So while we are balance sheet, a lot of the marketplaces are a lot longer, taking no risk. So if you really think about what you just said, the risk really lies on the longer term programs, regardless of the credit quality of the borrower.
Yeah, and I'd agree with that. The short term is generally less risky, but I'm just conscious that all of you chosen, I think, balance sheet lending models as opposed to marketplace
Right.
models.
I think also we just have to, you know, small business lending by nature is riskier, especially as you go down the credit score. So I think we're all sort of limited as how far out you can provide, you know, the repayment plan.
Right. What is the longest duration of lending that each of you do?
Ours varies by market, but I believe the most in any market is 15 months.
Okay, I mean, for us, our intention is that we receive our funds back normally between sort of 7 and 9 months. But naturally, with the way that our repayment works, which is geared to the cash flow of the customer, if that takes 2 years, then it takes 2 years. So typically, we try and price for something sub 12 months. Again, to David's point, you know, that's been our model. You know, we had to take the first investment in that. In 2007, we probably weren't going to get many funding houses comfortable with the type of product and the proposition we had. I think now that we've grown to the size that we've got, the opportunity to entertain institutional investors and retail investors sort of starts to open up now. But again, you know, we're relatively small. There's a lot of money that needs to be deployed. And I think one of the key things that we need to appreciate is that sometimes our vision and our values needs to be aligned with those of our investors. And I'm not sure that was talked about too much today, but certainly at Liberis we put a high degree on the lifetime value of the customer. And you have to make sure that your investment partners are co-joined with that philosophy. Otherwise that makes a very difficult board meeting on occasions, of course.
So your capital providers are on your board meetings?
I'm sorry?
Your capital providers are on your board meetings?
I couldn't possibly comment.
Christoph.
So the product that we are catered to small businesses is a revolving credit facility. So our customers are using us from time to time, or more frequently depending on their activities. So we don't have a set maturity on the product itself, although the maturity, on average, the term sort of that our customers are using us is generally, from a duration perspective, about 4 to 5 months, so relatively short from a risk perspective. Now, I think if we kind of were sitting here in 5 to 10 years, then probably all of us would have a hybrid model, whereby some parts of our balance sheet would be entirely securitized in whatever format, whether sort of that's loan by loan or sort of in a portfolio, where some of you might get access to that portfolio, and other bits might be funded by banks simply because they have a lower cost of funding but might not want to take certain buckets of risk on their balance sheet. So I think technology on the funding side will make a big difference in our business, as it will be more efficient efficiently allocating between different risk takers. So the risk takers that we're currently seeing in our market either hedge funds with very high sort of return thresholds that are too expensive for the majority of the risks that we are pricing and that we have on our books, and banks on the other end. So I think as our market develops, as marketing costs will come down and we'll sort of enter the real mainstream, you'll have the entire range of investors participating in the risk that we are originating, similar to how capital markets work in the securitization market. But it might actually not go through investment banks anymore. It might be sourced directly from us through APIs to you.
We've just seen from AltFi data the yields that retail investors are largely getting in the larger platforms here in the UK. How do you feel the capital providers that give you capital are pricing you relative to other lending platforms and marketplace lending platforms? Do you feel that your cost of capital is a lot more expensive and there's a good reason for that, or do you feel sort of almost like unfairly targeted? I'm slightly leading the witness here, maybe.
Well, there's a session a little bit later on around price discovery, and I think it's fair to say that certainly from my business model, which is very similar to David's, there ain't a lot of it about. So it's very difficult to actually understand what the pricing should be in this particular model. You know, we've had to get our recent investors very comfortable with our proposition. That's taken us quite a lot of time, so that when we're thinking about what we would expect new investors to come in at, it is an education piece. And certainly we don't have too many peer groups, certainly not publicly traded anyway, where you can get a visibility of performance so that you can start beginning to understand what an appropriate price is. But obviously from our perspective, we have to make sure that we price to our customers according to the risk of that customer. And in the same respect to the institutional investors will look for a return based on that principle too. There is a correlation.
I think similar to what Paul has said, I think part of the challenge is that myself, my co-panelists up here, we have the experience, right? I mean, in fact, some of us have even been through the full economic cycle, and a lot of lenders tend to be nervous when they hear about unsecured SME lending. And I think there's really a disconnect between established platforms like the gentleman up here, the three of us, where we can demonstrate default rates, where they may have seen high gross rates being charged, but as the acquisition cost has gotten higher and higher and higher, and there's been price compression coming down, the margins in our business have actually gotten less and less each year. So while the rates seemed high or lenders were charging a lot several years ago for the initial players in this game, I think you almost need two sets of rules. One for the established players that can provide a loan data to their portfolio, because simply that even though the top line rate seems high, the actual margins are much lower than when they've been in the past previously.
Although I think probably quite a lot of investors would say you've got high customer acquisition costs, you're charging high APRs, you've got relatively high loss rates to other platforms. Surely the risk must be higher and therefore I would need a higher return.
Everything you just said except the defaults. In other words, we can demonstrate as a company that, and I could speak openly for Capify, I could put my SME default rates up against some of the peer-to-peer platforms, lending to credit profiles much higher than mine because of our repayment methods, similar to what Paul and myself have through the credit card receipts, as well as our experience of how to provide. And what's really key is the short-term nature of this. A risky SME is a better bet over 6, 7, 8 months than a prime or super prime customer over 3 to 5 years, especially in economic downturn.
Okay, Christoph, do you want to come in?
So I think it's a question of scale in the end. I mean, price are determined by markets. There's supply and demand. I think a lot of the balance sheet lenders that have emerged over the last few years had to invest significantly more into their operations to get to the level of rigorous underwriting that is required in our space. Clearly, that also leads to significantly higher IP that we have developed, so will serve us over the long term. But our sort of golden age is still ahead of us. We will scale to very, very sizable companies, and as we scale, our price for financing will come down. So I do think we are somewhat negatively disadvantaged by the lending community, given sort of how much additional subordination and risk absorption we give. Our financing costs should be way lower than what you would see relative to marketplaces. But I'm very confident that as we scale and as our track record with every single transaction, every single month sort of becomes longer, that our financing costs will drop further.
So do you think that securitization is effectively going to be the end game of funding for pretty much all of you, and that therefore sort of retail and marketplace lending is really just an afterthought, in 5 years' time if you roll the clock forwards?
Well, one of the things, one of the reasons we had come over to the United Kingdom back in 2008 is being able to leverage our experience in the U.S. market, and pretty much 90 to 95% of it has followed over to the U.K. with about a 2 to 4 year lag. And what started happening about a year and a half or 2 years ago in the U.S. are our direct competitors have started to securitize. They've been rated by some of the U.S. rating agencies, and they've successfully done securitization. So I think, without disclosing, private company information, the challenge the three of us have up here compared to some of the marketplace lenders is our deal count, transaction unit count is very high, except our average deal size, because we're not going out 2, 3, 4, 5 years, is literally could be as much as 1/10 of what some of the marketplace SME lenders are. So while they're not necessarily, it looks like they're originating a lot more, their deal count's actually in some cases less than we're doing. So I think it's just a question of us amassing a big enough book that's going to get the interest level of, the same type of securitization that exists in the U.S. Because the first player that did this in the United States started literally in 1998.
So you're thinking your product is much more like a sort of credit card revolving trust securitization as opposed to like a mortgage securitization?
At a much smaller unit count. So in other words, your average unit count in the UK could be 15,000, 20,000 pounds compared to some of the marketplace lenders that could be 75 or 100,000 pounds.
Yeah, and I think to the point you just made there, I think if you look at what's happening in SME finance today, that the overdraft is disappearing rapidly, so there's a gap in the marketplace for that. I don't think that's going to be fully supported by business credit cards. So, the people on the platform don't have an opportunity to kind of fill that space, which is in support of other business models we've heard today. So it's not instead of, it's very much alongside. And our average fund is coming down year over year because people are looking for small amounts of finance that they can't find from anywhere else. And I think as long as we can scale the model appropriately, and then there'll be plenty of opportunity. Going back to securitization, I think it's probably an inevitability at some stage. Yeah.
Christoph, any
I think
views on
securitization is a very, very broad term. I would also say securitization of a single loan to 5 different retail investors, also securitization. So I think you will continue to see retail money accessing risk and getting a return, and that's sort of the benefit that marketplaces have created, that they have created sort of the market for that, they have created the technology, the platforms for that. And you'll see, of course, securitization to insurance companies, hedge funds, and other investors who are looking for very distinct risk-return profiles. A hedge fund wants to have 15% plus, they'll buy into a mezzanine tranche. And then a pension fund wants to have a AAA rated tranche, and they will buy that at Libor plus 50. So I think risk can be tailored to different sort of investors, and I think that has been done over the last 30 years and will continue to be the case. I think what we haven't mentioned yet, I wouldn't be surprised if one of the three would end up having a bank license too, because raising deposits is still among the cheapest forms of accessing financing. And if you have the scale that the additional costs in compliance and regulations are smaller than the benefit that you have in lower funding costs, it's absolutely worthwhile. It's also a very stable form relative to some of the other financing forms. So I think the structure of the banking world, the value of a bank's license is still going to be attractive for some of us in 5 or 10 years' time.
That's certainly very interesting, and having run a bank, I can sympathise with that. Although I would caution the cost of a banking license, even in the UK, where the cost has gone down, I would still put it probably at about £10 million or so to actually get a full banking license.
Yeah,
but that's only because the salaries are so high for the CEOs.
Now, it's all the risk people and the regulation people and whatever. And actually, I want to sort of come on to regulation. And all of you operate in the UK, but some of you also operate outside of the UK. How do you perceive the UK regulation of your industry relative to the other countries that you operate in? Do you think the UK is kind of like a golden age of regulation of this industry, or does it not really matter for your business models?
Well, I could speak in the 4 markets that we operate in. So the US, as I stated before, Capify started in 2002, and regulation has always been focused on the consumer aspect. And up until recently, driven by marketplace lending and peer-to-peer lending, there's been a lot of noise in the US right now about regulation. But I think regulation is a very subjective term rather than an objective term. I would be very surprised if any reputable company right now, especially my 2 co-panelists right here, if we're talking about procedures and reporting, that all of us can easily pass that test. The same noise now that we're sort of hearing today in the UK. I just got back a couple of weeks ago from the AltFi conference in Australia. Same thing's happening in Australia right now. Not as much in the UK, because Australia is a couple of years behind the UK. But we're starting to hear similar rumblings. Canada's been pretty much quiet when it comes to that. But I guess the question also comes around is that part of the noise of regulation is, are you being a responsible lender, but also what is the cost to the borrower? And especially on the consumer side, where I don't know of any markets where there's ever been regulation for B2B lending, the more regulation you add and the more reporting and the more auditing requirements is only going to increase the cost for the lender to deliver the money to the borrower, which indirectly is going to get passed along to them.
I'm conscious that in some European countries, for instance, you need a banking license just to be able to lend. Never mind take deposits. Not so in the UK. So just
right. None of the markets that we operate in require a banking license.
So you're operating in markets where effectively lending is relatively lightly regulated, but there is protection of the borrower, but the actual act of lending itself is not.
Well, there's
regulated.
one caveat to that. In the U.S., we have 2 products. We have the business cash advance product, similar to what we have here, and then we also have a business loan product. In the United States, each state has a different legal commercial usury limit, the maximum amount you could charge for interest. So in those states, we actually partner with a national bank where we, in essence, are marketing the bank's program. They are originating the loans. They are rubber stamping our underwriting, and then we are repurchasing the loans. That, in theory, is a regulated product because it's actually being monitored and actually originated by a bank, which obviously is regulated by the FDIC.
Well, I think similar things happen in Europe, right?
So we operate in the UK, Germany, Poland, and Spain. I find that the UK is by far the most developed credit market out of all of those 4, both sort of from a consumer and business perspective, and of course from a marketplace perspective. The largest platforms are here in the UK. There's this ecosystem here in London in particular between the government, banks, and fintech innovators, as well as the regulator, which I think is very, very healthy in creating the dialogue that we need to craft the right regulation for the industry. But from a credit perspective, it is already the most developed market, and I think has the best set of regulation to protect borrowers, but also make sure that lending is happening at the same time. Germany would be on the other end of that, as you correctly pointed out. In Germany, you can't do a loan without a bank license, which in itself doesn't really make that much sense, because as a deposit-taking bank, yes, you need to be regulated to make sure that you're not running away with a bank that sort of retail investors give you. But there's absolutely no reason why you can't give a loan to a business. And it's just making it harder for us. So we had to partner up with a bank in Germany that is the lender of record of every transaction that they do with customers that we help them to service. And I'd say, if the UK is the benchmark, then probably Germany would be 120% on the sort of difficulty scale, and the other regions where we're in probably somewhere in between those 2.
Yeah, I mean, listen, our product in the UK is unregulated. It's a semi-invoice factoring model. So as such, you know, at the moment it doesn't attract regulation. That doesn't mean that we don't behave like a regulated company, because I think one thing that's for sure, if you misbehave, then you will attract the regulators. So I think as we've had to demonstrate for the British Business Bank, you know, we act as a fit and proper lender, even though in truth we buy receivables.
Well, there's certainly a lot of government money, I think, being lent through some of you, as far as I know. But anyway, I'm being given the sign that I think our time is up, so handing over back to David. Thank you.